Welcome back. Well, there's a bit of a turnaround happening in the weakest NBFCs. Just pull out the intraday chart of Diwan Housing, DHFL. Remember, it was 10% circuit down. It's now actually in the green. It's 2% higher now. So intraday, there's a 12% recovery that you're seeing. Canpin Homes is the other one where you're seeing a bit of a recovery. So interesting moves happening in the NBFC space right now. We have Pratik Gupta, Head of Equities of Deutsche Bank India, now joining us. Pratik, good morning. So, what's the mood? Over the last few days, we have seen relentless FII selling. Is this largely a function of the US bond yield going up, or is this India-specific, or a combination of both, you reckon?
I would say it's a combination of both, but there are other factors also. It's also driven by oil prices. Also keep in mind, we've seen a shift, at least at Deutsche, we're seeing a lot of our global investors moving money from Asia per se, within the EM space, towards markets like Mexico and Brazil. There are some very country-specific factors over there. Mexico, we had the trade deal in the US. In the case of Brazil, there is a political angle there. There's an election happening, expectations of a strong government coming in over there. So those kind of country-specific factors. Whereas in Asia, we've had China, where the trade war worries are getting worse, and there is an expectation that the Chinese economy will slow down even further. India, we've had our own problems specifically related to oil, and very lately with this liquidity crunch we're seeing in the money markets. So I don't think it's bond yields per se. That is just one of the factors, but it's a combination of various factors which is finally driving, we're seeing a lot of redemptions from the FIIs, a lot of selling from the FIIs, and this unfortunately, other than valuations coming off a bit more, we don't see what could change this in the near term. The other trigger obviously could be oil prices. If oil stabilizes or India can strike a deal with Iran and get the US waiver on that, that might be a bit of a relief. But in the short term, unfortunately, there are still quite a lot of headwinds.
Okay, a little bit of a headwind has developed over the last 1 hour after the markets opened. Brent has now climbed to 84.4. Early morning, we had seen south of 84 and then 84.01 and now 84.4. And the rupee has sneaked up to 73.99 as we speak. Not a very good multiplication, 84.5 into 74. But that's what I wanted to speak to you about. Pratik, are people telling you that at 74 rupees and 8% bonds, or at 74 rupees and Nifty at 10,200, something is now becoming attractive?
Yeah, I think we are beginning to get a lot of inquiries, at least at Deutsche. We are seeing a lot of foreign funds now inquiring that, look, is this a good time to buy? Which are the stocks which are in the oversold zone? But are we seeing people actually come in and put in big buy trades? Not yet, because they're now, this is getting attractive. Our own house view is oil will probably average around $80 a barrel for the fourth quarter. Like I said, there's upside from India signing an Iran deal and getting a US waiver. We could have a situation where, this liquidity crunch, our view is this is not going to be a full-blown crisis. We think this is a temporary issue. In the next 3 to 6 weeks, this will probably get sorted out. So there will be some impact on growth, but not enough to derail the overall growth momentum. So given an environment where over the next 2-3 years, we think earnings growth will be in the region of 15 to 20%, maybe even more, and given the sharp correction we've seen in the markets over the last 2 weeks or so, there is definitely some interest coming back in. But I would say overall, the broader investor base globally is still somewhat cautious, given the uncertainty on oil and now lately China.
Pratik, good morning. So right now the FIs are inquiring. They've not removed their checkbooks. How much more do valuations need to correct before India appears attractive to them?
Well, I think there's one aspect is the valuation aspect. So there, I think we're getting there already, maybe another 4-5%. At the index level, that starts getting even more attractive. But I think the other driver is really some clarity on the oil price, because that's the big uncertainty. I mean, back when we were at $65, $70, back then $85 was not expected. And lately, there are talks of, oil might even continue to spike up if there's any kind of a supply disruption. So one is clarity on oil and India's ability to sign a deal with Iran. That's one aspect. The other big uncertainty is around the Chinese economy. If that slows down very sharply and you could see perhaps a little bit more of the Chinese RMB depreciating, then that imposes a new round of headwinds for the Indian rupee. Then the Indian rupee to RMB rate has to be kept in sync. You could see a further, 2, 3, 4% decline in the rupee in that case. So those are the things which are keeping, so it's the macro headwinds rather than anything really India specific, except in the NBFC space where there's obviously the liquidity crunch issue is there. But by and large, it's those kind of global headwinds which is really bothering investors. And that's unfortunately, you can't really know for sure which way things will go.
So this move that we have seen, move away from financials into IT and pharma, you reckon there's more to go here, because now that's the most overcrowded trade?
It is. I think maybe a little bit more, but I think the bulk of that move is largely done in our view. In fact, our view is, and we've been saying this for a while now, that the liquidity environment is going to remain tight, but the high CASA, high growth banks should do relatively better. IT, we have a modest overweight, but these stocks have already moved up quite a bit. Pharma, we think between IT and pharma, we prefer IT. Pharma, we think there's still structural challenges. We think consensus estimates are still quite optimistic. We think valuations, most of these companies still trade well above 20 times the 1-year forward earnings. So overall, we still prefer IT to pharma. But yes, the move has begun. And I think our advice to most investors would be start looking selectively at the domestic cyclicals, not the exporters so much.
Okay. Well, I know you're not very worried about the liquidity freeze and the NBFCs not lending at the moment, or not able to lend at the moment. But we've seen quite a bit of correction in consumer goods for fear that demand is not picking up. The numbers also said that. You don't fear any earnings downgrade at all?
No, there'll be a little bit, but I don't think you'll see, when you're talking of consumer goods, you have consumer staples and the consumer discretionaries. In the auto space, for example, there definitely our numbers have been below consensus, and I think this latest round of last couple of weeks, and maybe this liquidity crunch carries on for some more weeks, there we have had a negative view, and we continue to maintain that, especially, for example, the mass market two-wheeler segment, we're quite negative over there. Our earnings estimates are significantly below consensus. So the discretionary space in general, in the auto sector, we would be careful. But then you have the other, the other consumer plays where I think the correction has been quite meaningful. So there we're quite comfortable. And don't forget, the rural economy is still doing relatively strong. In fact, we've seen this over the last 30 years or so. Every time in the 6 months before the elections, one thing you can be absolutely sure of is that the rural economy tends to do quite well because of a lot of pump priming, a lot of rural schemes, a lot of infrastructure projects, spending in the rural areas, etc. So companies which are rural focused should do relatively better.
Prateek, what about the oil and gas space? How do you view the government's move to make oil marketing companies absorb 1 rupee of the fuel price hike? Would you see it as a rollback of the deregulation regime? And how would you approach it as a sector and individual companies there?
So our view has been, and it's unfortunate our fears turned out to be true, that the government, if the oil price spikes up, they might impose some kind of a subsidy burden on the OMCs. And that's one of the reasons why since the start of this year, we have been underweight the OMCs. Now we've seen a very sharp valuation correction, so we're only neutral on these stocks right now. But I think that move did spook a lot of global investors. It was seen as a reversal of reforms, although we hope that this is just a one-off and this doesn't get repeated. But within the oil and gas space, which is why, because of these worries on oil price and we're in a pre-election period, the risk of populism is there, which is why we actually prefer the gas utilities, where there's a much longer structural story over there. Gas demand in India is growing in double digits. LNG, especially compared to oil, now gets more attractive environmentally. The government is pushing that. You've had the city gas licenses being given out recently. The gas infrastructure is being built out. So in particular, some of these terminal companies, they look quite good to us. So which is why within the oil and gas space, we prefer the gas utilities in particular.
Okay, your latest report says that the MF flows into equities show resilience. Now, I personally checked with my MSP, with my financial, intermediary, and he says if I have to call back an SIP, they will still take next month's. It's only from the next 10th
Correct.
that they will stop the SIP. So, do you think the bad news is going to come in October, November?
No, it's quite, I think that is definitely one of the risks to the market, that for people with 1 year, 2 year SIPs, they actually, I think the returns would be in the negative zone right now. So there is a risk. The October, or rather, I think the November figure will probably be a more realistic figure to figure out how good or bad things are. But At the same time, bear in mind that the other risk asset classes like real estate or gold are still not that attractive, and we've seen a big fall in equities. And I think this time around, there's been a lot of education with investors that stay invested in the long term. When the market falls, that's the time you should not pull back your SIP. So let's see how much impact that industry education has. But I would agree with you that looking at just the August-September number might be a bit misleading. The fall has happened only now, and we should look at the November SIP to figure out whether there's been an impact on the flows. But in general, I would agree that it's the domestic flow which is what's holding up our markets, and we need to watch that very carefully, and let's hope that carries on.
All right. Pleasure speaking with you, Pratik.
Right.
Thank you very much for dropping in our studios. So that's again a cautious view, but not very pessimistic view either, expecting that things should improve. Well, we spoke about equity mutual fund numbers with Pratik Gupta of Deutsche Bank, but the flows data in the debt mutual fund is the one that's worrying, especially liquid mutual funds, saw an outflow of 2.11 lakh crore. What does that mean to the debt mutual funds and therefore to the economy itself? Suyash Chaudhary, head fixed income of IDFC Mutual Fund, joins us now. Remember, the IDFC Mutual Fund was the winner of the Debt Mutual Fund Award at this CNBC TV 18 Mutual Fund Awards function this year. So congratulations yet again, Suyash. But, you know, the difficult question really is 2.11 lakh crore flowed out. How much of it is coming back with the start of the month and salaries all paid out?
So Lata, as with all things, it's important to have some context to this. One, liquid funds are the most low involvement products that you can buy on the mutual fund platform. So they are literally for overnight deployment of money. So the flow into liquid funds is also very closely correlated to general liquidity conditions in the economy. And as you know, over the month of September, not only is there advance tax, but because of various reasons, money market rates had spiked very substantially. As a result of that, there is some negative flow to liquid fund, or some of the negative flow probably got exaggerated. The other aspect is, the last 1.5 odd years of comparison is probably futile because liquidity has been just too abundant for the last 1.5 years. So remember, post demonetization, there was a veritable liquidity glut. And, fair comparisons are probably better had if you compare data of 2014 and 15 versus what's happened in 2018. And if you compare versus that, it's slightly higher, but not something that is very alarming. Final point, with October kicking in, a lot of money seems to be coming back as well. I can report on our case, funds have grown in the liquid space over the month of October as clients have reallocated to the fund space. So, I would not cause too much alarm with respect to the 2 lakh crore outflow. In the scheme of things, it is, well within par for the course.
So yes, and anecdotal evidence tells you that even other debt funds have seen inflows in the liquid and income funds so far in the first week of October. Not just your fund.
So again, taking a step back, yes. So to take a step back, the other data point being talked about is the outflow of around 30,000 crores in the income category. Now, right off one should understand that when one talks about income here, one is clubbing everything from ultra short to income to dynamic bond, possibly even fixed maturity plans. Because if you see, the pie there is stated to be 7.5 lakh crores. Now 30,000 crores on 7.5 lakh crores, given the interest rate volatility that is, with us right now, it's again, really par for the course. In fact, if you skip data for the last 2 months, in the months prior to that, if I remember correctly, income funds had lost 20,000 crores on trot for 2 successive months, and there was no, credit-specific event happening then. So again, I would think this is very much in stride for the MF industry. Now, this category of fund has been losing or not net getting money for a while now, and that's more a function of interest rate volatility. So in the month of October, I wouldn't expect much money would have come into this category, but that's really a function of the volatility in rates. As you very well know, rates have been extremely volatile. Only in the last few days, courtesy RBI action, have we had some semblance of stability. Plus, forward view on liquidity for most people is quite hawkish. So if RBI were to, not be very proactive in creation of liquidity, we are seeing core liquidity deficit at -2% of net demand time liabilities of banks by 15th of March. And this is, pre-advanced tax. So clearly, there is a liquidity premium in the market which RBI seems to be pushing against, and that is also getting reflected in the income fund AUMs.
So you mean they have to do 40,000 crore OMO every month, then only they will kind of keep liquidity square?
The calculation seems to suggest that. So, to give you a very near-term example, by 10th of November itself, core liquidity will be in excess of 1 lakh crore deficit if RBI had done nothing. So, as we know, RBI is doing 36,000 crores of OMO this month. But my sense is, if more is not happening, then even then core liquidity will be in excess of -50,000 crore negative at 10th or 15th of November.
Okay. Well, let me come to the the stock market interest in your debt income fund. The stock market's interest is anyone? Are you or is anyone refinancing NBFCs?
So Lata, to the broadest extent possible, people is our sense, at least from our industry. There may be specific concerns with respect to potentially specific names, which I wouldn't have really a view on, or I don't want to get into. But the limited point here is, as flow comes back, as it is coming back in the month of October, we are seeing rates on CPs dropping as well. So, from peak, most CP rates are down around 50-60 basis points.
NBFC CPs?
Obviously the RBI's LCR relaxations have played a part, the liquidity injections.
NBFC
HFCs,
CPs?
yes, some NBFCs as well.
Okay. Okay. Well, I just wanted to ask you this last question. The talk is that NBFCs are not getting refinancing from mutual funds. They've gone to banks, and yesterday we had a NBFC telling us that banks are not allowing them to draw up to their spending, their sanctioned limits, and therefore now NBFCs are selling their asset portfolio. Is the situation of that order now?
Look, so mutual funds ultimately are pass-through vehicles, and they will lean in the direction of the way the wind of risk is blowing. So nobody would stand against that, given that we are largely pass-through vehicles where assets under management can turn volatile should a credit event strike, which to a very large extent it hasn't so far, barring the ILFS issue. Now, banks with more static balance sheets are the ones who need to step in a situation like this. I am not privy to what kind of refinancing is being done by banks, but if open lines or lines that had been sanctioned earlier are now being revoked, then obviously the system or some part of the system needs to step in, probably regulatory driven. If on the other hand the sanctioned lines are being honored, then I don't see any of the large HFCs facing any sort of a liquidity issue. Most of the HFC ALMs are in the public domain. They have been proactive in putting them out. Given the fact that many of them would also be incrementally slowing business, which would reduce the net cash outflow over a monthly cycle, so long as even 50-60% of the bank lines are standing, I really don't think there is a liquidity issue plaguing at least the large HFC and NBFCs.
All right. Sure, we'll leave it there. Thanks a lot for your time today.
I just wanted to add that this is exactly the story that bankers are telling us. That when people say that bankers should lend up to their sanctioned limits, they say their point is, why are mutual funds not lending in the first place to NBFCs? Because you're in doubt, and if you are in doubt of the asset quality, should I also not be in doubt? Would I not be questioned by my board or my investigative agency?
Exactly.
So there is a bit of a freeze on that.
That's what the classical definition of freeze right now, of course. It's impacting the market as well. The mid-cap index for sure is now down about 0.5%. Even the bank Nifty is in the red. Ashwini Gujral, Mitesh Thakkar back with us. Rajat Bose is also joining us. Actually, all over the place, the first hour. Is it going to be that kind of a day? Can the market recover as well from here? How would you approach trading?
While the market has come off, it's not come off very sharply, and just right here, there are supports. If we hold on to these 10,300 kind of zones, the market is ready for more pullback. And today, interestingly, financials are not doing too badly. And housing finance particularly is doing fairly well. So my sense is that there has to be one more attempt towards higher levels. So this is a good time to get long on Nifty as well as Bank Nifty. Obviously, you need to keep a 30-40 point stop on the Nifty, maybe 50-70 on Bank Nifty. But I would like to buy this dip because just a one-day pullback possibly is not enough, and the market is not seeing a lot of selling pressure. It looks like a corrective action. Having said that, Canfin Home is a buy with a stop of 226, target of 241. DHFL is a buy with a stop of 220, target of 234. And HDFC is a buy with a stop of 1680, target of 1730.
Okay, a buy on Divan Housing as well. For now, the Nifty is off about 70 points from the top of the day, while the Sensex has lost about 300 points from the top. Mitesh Thakkar and Rajat Bose also with us on the show. Mitesh, would you recommend buying this dip?
See, not really, because I don't think I have a very clear sense of direction. The only thing which I mentioned in the morning as well was sustaining about 10,400 is important. That has not happened. Twice during the first hour, we went there and kind of came back from there. So I'm not very keen to buy aggressively right now. Maybe trade more on stock specific basis. And the calls that I have right now are a buy on Hero Motors with a stop at 28.75 for targets close to about 29.80. And Marico, I think it's dropped a bit, but around 305, 306 would be a good sell. Keep a stop at 310, look for targets of 295.
Okay, and Rajat, good morning. What are your stocks?
Well, I'm also buying, and I feel that unless 10,310 to about 10,280 support zone gets broken, this rally can continue and would likely to test, say, 400 to about 420 on the upside. So I've chosen two stocks. One is NID Tech. I would buy the October futures with a stop below 1112, and the targets would be 1139 and 1148. And Lupin, I would put a stop loss below 849 and buy it in the cash. 868 and 874 are the two targets for Lupin. Lupin is showing some relative strength, so possibly there could be a good upside movement. And today could be a pullback day.
Today could be a pullback day. Actually, the point that you're making on housing finance, in fact, there's more joining in now. LIC Housing Finance is up about 4%. Repco Home Finance is up about 3%. Apart from DHFL and Canfin, and anything else? HDFC, of course, is also the one that you are chasing. But anything else that looks good?
See, basically, NBFCs are coming back, and that is number one condition for any sort of pullback to sustain. So my sense is Bajaj Finance, FinServ, once this thing picks up that, short covering on NBFCs, I think all NBFCs will join in. Everything is down 50-60%. So that is a must if we have to move forward on the pullback. So basically all kinds of housing finance particularly and NBFCs in general, they are now showing short covering from lower levels.
Okay, it's choppy for sure. Thank you, gentlemen, for joining in. For now, it's many of these oil marketing companies and even consumption names like Titan, Asian Paints, which is slipping, and Reliance Industries too. After that powerful rally that took place yesterday, Reliance Industries has given up some of its gains. So that's down more than about 0.5%. Manisha joins in for a complete roundup of the action at 10 a.m. Manisha?
Well, thank you so much for that. Strength back again for the crude oil prices. Yesterday we were a percentage point down, and today we've opened 0.5% on the higher side for crude. The global markets also have seen buying come in. We have seen the U.S. rig count continue to decline for a third straight week. The Iran exports have continued to decline as well, from 2.5 million barrels per day in the month of April to 1.1 million barrel per day has been the latest number that has come in. So while, of course, we will continue to see a lot of movement in those numbers, but at this point in time, the immediate supply tightness is the theme that the markets are working with, and that has been supportive. Add to that the fact that you also are looking at the strong demand estimates to continue. There is yet another hurricane brewing now on the east side of Gulf of Mexico, where 19% of production has been shut on precaution. So these are some bullish fundamentals which have supported the crude oil prices yet again. And the hedge funds, which actually had unwinded their positions in the previous week, which led to nearly a 4% decline in crude oil prices, seem to be buying back again now at these current levels. So that is yet another thing which is supporting the prices. On the other side, you also have seen the strength in US dollar, the US Treasury yields continuing to surge up. That has been putting pressure onto the gold and silver prices. But we have seen some bargain buying onto these levels as well. The Italy concerns are back yet again, and the markets would be watching out for some more economic data, especially from Asia itself. And there are reports on how the physical buying in India and China seems to be now picking up ahead of the festivals and the New Year, and that has led to some bargain buying onto this space as well. Add to that the depreciation in the Indian rupee, and that's exactly what you get on your screens. The base metal prices have been all over the place. We continue to see the pressure in case of the aluminum prices. That one actually has declined by 9% until now from the kind of highs that we saw last Thursday. So it really has been these 4-5 sessions when we have seen very sharp cuts come in for the aluminum prices. But with what China really seems to be doing in sense of cutting the bank requirement ratio, the tax rebate reforms that they seem to be putting in has helped the metal prices. Not so much on LME, but Shanghai definitely has gone in for buying. So you have the zinc prices trading at a 3-month highs. We also have seen some buying come back on the steel prices from the kind of levels it opened in the morning. And you can see that on the non-ferrous space as well. So almost everything up by 0.5% on your screens, barring aluminum, where the fundamentals really are on the weaker side. Trading strategies then, and we have them from Grow Value. They have a buy call continuing in case of copper. 471 is the level that they're watching out for the day today. They also have a buy in aluminum at these lower levels. 161 is their target for today. And in case of energy, natural gas is their pick. They're looking to buy that as well. 248 per MMBTU is what you can look for that one.
Okay, Manisha, thank you very much for that. We'll slip into a very short break. As we do that, India's largest airline, Indigo, is borrowing a page from several international airlines. It is aggressively outsmarting the likes of SpiceJet, Go Air, Air Asia, amongst others, by launching international flights on routes rivals are about to begin operations in. So what exactly is the network mirroring, and how is Indigo perfecting the art of it? For more on that story, log on to cnbctv18.com.
Okay. All right, that's a special offering from our website. For the moment, it's a break, and you're going to tackle the issue of coal shortage for captive power plants with Harry Dole, Director General of the Independent Power Producers of India.